What has been the impact on oil prices of Russia invading Ukraine? Kolachkowski. Prices of oil and gas increased sharply, with both major oil benchmarks trading today at above $110, which represents a further 15% increase over last week. Currently, energy exports are not subject to sanctions on Russia. Europe is seeking alternatives, with reports suggesting that refiners should avoid taking Russian oil supplies. At the same time, Russia is still able to find a market for the majority of its production by offering discounts in the order of $15-20. Clearly, the war continues to increase pressure on the system. Some analysts say that the risk of disruption to supplies has not yet been fully priced in and we may be poised for a further run upwards. On the other hand, OECD countries are releasing 60 million barrels of oil, an equivalent of 12 days of Russian exports, from their strategic reserves to the market. The move is aimed at easing the price pressure. However, as history shows, such actions have only short-lived and limited impact on prices. What is released today will need to be replenished in the near future. U.S. ban on Russian oil imports. The Biden administration banned Russian oil imports to the U.S. What could the administration do to lower gas prices in the U.S.? The Russian invasion of Ukraine hugely exacerbated the strong economic recovery coupled with low investment in oil production. This sent the oil price to stratospheric levels, and this is being passed over to consumers at the pump. In the short term, if the administration wanted to lower gas prices, there are some mechanisms to unlock. These include decreasing or suspending federal taxes on gasoline and diesel, which are 18.4 and 24.4 cents per gallon, respectively. It could also work with state governments to do the same. State taxes average 30.63 and 32.29 cents per gallon, hence combined gains could amount to 50 cents per gallon. Another option could include releasing more from strategic reserves to the market. However, as recent and previous actions show, this would have only a short-lived and limited impact on prices. What is released today will need to be replenished in the near future. In the longer term, a more supportive approach to increasing domestic and international production would help. But most importantly, I believe that the key to the energy transition is in consumers' hands. The biggest shift will need to happen on this side of the equation. Rising energy prices. How will this impact consumer energy prices? Again, it is hard to predict which way the situation in markets will go. However, it seems that we are poised for a period of high energy prices that are driven by war and combined with tight market fundamentals. High prices are being passed over to consumers at the pump, in their gas, heating, and electricity bills. And high energy prices contribute to the increased costs of virtually all goods and services, further fueling inflation expectations. High energy prices contribute to the increased costs of virtually all goods and services, further fueling inflation expectations. Some governments may introduce measures to cushion consumers from this increase. In many countries, taxes on diesel and gasoline represent more than half of the price paid by consumers at the pump, so clearly there is a space for government action. However, all, or almost all, of this cost will need to be picked up by consumers. Unfortunately, it seems that we are in for a prolonged period of expensive energy. Energy transition. How does this impact the energy transition? There are different dimensions to this question, and it will depend on the response by consumers, businesses, and governments. I expect that the impact will vary, with some trends accelerating and others reversing the energy transition. First and foremost, energy security and affordability are back at the top of the agenda. It seems that climate change and sustainability are not the #1 priority anymore. Europe seems to be rethinking its reliance on imported fuels. We may see a renaissance of nuclear and locally mined coal, along with further accelerated renewable investments in an effort to substitute gas and coal imported in large quantities from Russia. Germany is already considering extending the life of its nuclear plants and reversing the trend of phasing out coal mining. Other countries may follow suit. In relation to oil, high prices naturally improve the economics of alternatives like electric or hydrogen vehicles. Combined with the need to decrease import dependence, I could imagine a serious policy push followed by a strong consumer response to deploy electric vehicles and other solutions quicker and at a greater scale. Achieving a substantial change, however, would take years if not decades. For example, in Norway, where 65% of all vehicles sold in 2021 were electric, oil demand has fallen less than 10% since 2013. Individual action. Is there anything we can do as individuals? I believe that the key to the energy transition is in our hands. The huge change required needs to be led by consumers, individuals, and industry. For example, if EU citizens adjusted car driving patterns to average levels observed in Hungary, the entire imports of oil from Russia would not be needed at all. It would greatly improve energy security, significantly cut CO2 emissions, and dwarf the key source of income for the Russian government. In the end, it is up to every one of us. If EU citizens adjusted car driving patterns to average levels observed in Hungary, the entire imports of oil from Russia would not be needed at all. Collective change. Would this require many people to radically change their lifestyles? This is exactly the challenge. There is a couple of billion small, individual energy transitions that need to happen. The more a person consumes, the bigger responsibility they have. So, make cautious choices and create demand for better products. Very importantly, if you can afford it, be ready to pay more for an alternative that drives the change you want to see.